Share your money, stabilize your life. Welcome to Kelly Sharing. I'm Kelly, sharing practical and thoughtful insights on money.
Everyone's been talking about one thing lately. What's the biggest risk for software engineers? Layoffs, AI replacement, the 35-year-old crisis, or the tech cycle turning downward. If you scroll news, forums, and social media, you will see the same anxiety over and over. Will I lose my job? But today, I want to share you a very counterintuitive conclusion. For high-income software engineers, the biggest risk is often not unemployment. What truly danger is something more hidden. Behind the high income, the financial structure is fragile. You might have a higher salary, lots of stock, lots of accounts, lots of investments, but the foundation is empty. It looks like asset accumulations on the surface, but there's no shock-absorbing layer. It's like a gorgeous high-rise built without earthquake resistance. When a shock hits, it doesn't decline slowly. It collapses into imbalance fast. And the harshest truth is, the higher your income, the easier it is to overlook this. Because when money comes fast, your risk sensitivity gets dulled. In this video, I will use a real structural case, long-term research observations, and a financial framework. By the end, you will know how to turn high income into real safety. We are going to unpack what many high-income tech professionals have never systematically seen. High income does not equal to safety. Smart people fall into structural traps. More investing does not equal to more resilient. More accounts does not equal to a real system. Strong skills does not equal to a stable finance. If you have a software engineer friend, please send this to them. Let me start with a very typical case, common among high-income tech professionals. This isn't an exception, it's a pattern. He's a core engineer at a big tech company. His compensation package looks perfect. Base salary, performance bonus, RSUs, and stock appreciation. Total compensation is very high. To most people, he's the definition of safe. And he's not someone who ignored money. He's rational, smart, and disciplined. He did everything that looks correct. His dollar cost averaged into ETFs. He bought index funds. He held growth stocks. He used his 401k. He used his HSA. He used tax advantage account. He automated his investing. Sounds like A+ students, right? If you only look at the checklist, he's basically perfect. But then I help him map a full financial structure diagram. Not balance, not returns, a risk structural map. And the issues show up immediately. All his income, assets, and growth were tied to the same risk source. Let's break it down. Salary, tied to the tech industry. RSUs, tied to the tech company. Stocks, mostly tech. ETFs, heavy Nasdaq exposure. Bonus, tied to the company performance. Career path, tied to the industry cycle. On the surface, many accounts. In reality, one risk source. So I told him, this isn't diversification. This is the same risk held in multiple wrappers. Then what happened? Nothing dramatic, just 3 common real-life events. Organizational restructuring and team downsizing. A tech market pullback. A family health issues requiring ongoing medical spending. None of this alone is extreme, but together, the system breaks. The pattern is predictable. Income becomes unstable. RSU pause. Portfolio strains. Cash flow pressures rises. Medical costs increase. Stress explodes. He said something I will never forget. I thought I was being really safe. That matters, because he didn't say, I didn't invest. He said, I invested a lot. That's the key. The question isn't whether you took actions. It's whether those actions form a structure. It wasn't a product problem, not a skill problem. It was a system design problem, not shock resistant built-in. Many high-income tech professionals don't lose because they can't earn. They lose because their structure can take a hit. A lot of people hold a very intuitive but dangerous belief. High income equals financial safety. It sounds reasonable, right? You earn more money, you should be safer. But behavioral finance research has repeatedly shown this is often false. Long-term investor behavior studies consistently show high-income groups are not automatically financially stable groups. In many market cycles, their investment outcomes are actually more volatile. Why? Because behavior patterns are different. Research organizations often find that higher earners are more likely to concentrate assets, be overconfident in decisions, delay protections planning, underestimated tail risk, believe future incomes can fix everything. When income rises steadily for years, risk sensitivity naturally goes down. Many investor behavior reports summarize it like this. Investment outcome differences come from more behavior and structure than from income level. In plain language, earning more does not automatically make you a better investor. In asset management literature, there is a frequently cited classic study. The 1986 Princeton Hoopy Board study found that for long-term portfolios, assets allocation structure explains most performance differences, not individual stock picking skill. In simple words, where your money is structured matters more than which stocks you pick. Structure beats intelligence in long-term finance. Now let's apply this research conclusion specifically to software engineers. Tech professionals show very clear structural risk patterns. When we map this finding onto high-income engineers, one pattern stands out. The problem is not whether they invest, but whether their risks are actually separated. Let's break this into 4 common structural risks. Risk 1 is single-source income risk. Most high-income engineers rely heavily on one employer, one industry, one technical track. This is called single-source income risk. Here is a realistic scenario. Income is high, but the company restructures, the whole team is cut, and the skill track is too narrow. Suddenly, there are no equivalent roles in the market. This is not a skill failure. It's a structural failure. Risk 2 is correlated assets risk. Many engineer portfolios look like this. Tech stocks, Nasdaq, ETFs, company RSUs, growth funds, AI film funds. Many accounts same risk driver. In assets research, this is called correlation risk. If everything falls together, that's not diversification. That's synchronized exposure. True diversification means different risk drivers, not just more products. More position does not equal to diversify. Different drivers equal to diversify. Risk 3 is missing the risk isolation layer. Third structural risk I see all the time is this. There is no real risk isolation layer. Let me introduce a framework I explained in an earlier video. The 4-layer financial structures model. Layer 1, cash flow stability. Layer 2, risk isolations and protection. Layer 3, growth assets and investing. Layer 4, tax structure and efficiency. Most high-income tech professionals skip Layer 2. They go straight from income to investing. They focus on growth, returns, yield, and portfolio size, but build no short buffer. I have reviewed many financial structures like this. Multiple investment accounts, but no income protections. No health risk buffer. No household cash flow continuity design. Structurally, this is a missing shock absorption layer. It's like building a high-rise without earthquake engineering. It looks strong until stress hits. And there's one more structural risk directly connected to this. Their protection system is employer-dependent. Health insurance tied to the job. Disability coverage tied to the job. Life insurance often tied to the job. Everything looks protected, but only while employment continues. When layoffs happen, coverage can disappear or become very expensive very quickly. That creates a dangerous compliance. Income drops and protections weakens at the same time. Good financial structure is designed to prevent exactly this. One event should not be able to break every layer at once. Risk 4 is rising fixed lifestyle cost. Now, even if you fix structure and diversification, there's still one more pressure point. The 4th structural risk is rarely discussed, but extremely common. Rising fixed lifestyle costs. What usually happens when income goes up? Lifestyle upgrades follow. A better home, a better school district, a better car, more family responsibilities, supporting parents, children's education planning. None of these are long. They are natural and often meaningful choices. But financially, they share one important trait. They are fixed costs. They don't go down quickly. They are hard to reserve. Now compare that with income, especially tech income. Income is cyclical. It's market-driven. It's industry-sensitive. It can fluctuate, so a classic structural conflict appears. Fixed expenses meet variable income. Family finance research repeatedly shows this mismatch is a major stress trigger because when income drops, expenses don't adjust at the same speed. Cash flow gets squeezed fast. Many high-income families don't fall because they earn too little. They fall because their fixed costs are too high. Here's a very interesting, very important psychological pattern. I have observed this across engineers, programmers, and data professionals. They share a common cognitive habit. When a problem appears, I solve it. System breaks, fix it. Code crashes, debug it. Architecture unstable, refactor it. Performance low, optimize it. This is a core strength built through technical training. It's one of the greatest advantages technical people have. This mindset is called reactive problem solving. Wait, analyze, fix, improve. In engineering, this model works extremely well, but financial risk management is a different system. It's not reactive. It is preventive by design. You don't fix financial disasters after they hit. You design buffers before they happen. You cannot buy insurance after the fire. Plan cash reserve after income stops. Build protections after health collapses. Diversify after industry declines because many financial shocks have no repair window. Behavioral research repeatedly finds something important. High cognitive ability people are more likely to underestimate low probability, high impact risks. They believe their future self will handle it. This is sometimes called ability replace safety bias. I'm capable. I will fix it later. Because real-world risk is not linear. It doesn't arise slowly and politely. It arises suddenly and often stacked. Layoff plus market drop plus family expense spike at the same time. I had heard many brilliant engineers say, I will deal with it when needed. That works in software systems. It often fails in financial systems. Engineering thinking. Solve problems after they appear. Financial structure thinking. Don't let problems become fatal. Software can be hot-fixed. Household finance often cannot. It needs redundancy design in advance. So this is not about intelligence. Ironically, it's often because people are too capable. They rely too much on future-facing power and underestimate preventive structure. So don't blame yourself for not starting earlier. Start strengthening the structures now. Let me give you a practical checklist. So what does real safety come from? Not high income, not high returns, not many accounts, not many products. Real safety comes from one thing, complete structure. Safety is not a number, it's a system. Not how much you make, but whether the system absorbs shocks. For high-income tech professionals, your structure should include a cash buffer, income protection layer, health risk protections, long-term risk planning, non-correlated assets, tax-efficient accounts, family cash flow continuity layer. You don't need to finish everything at once, but the structure must exist. High income helps you run fast. Structure helps you to last long. Most people don't fail at earning. They fail at surviving a big shock. If you are a software engineer or you know a high-income tech professional, please share this video with them. Many structural risks cannot be solved by ability, only by early design. The more capable you are, the more you deserve a stable structure. If you want deeper breakdowns on the 4-layer financial structures model, top 3 traps for high earners, risk control frameworks, check my earlier videos. And if you want personalized guidance, you can book a private consultation section with me. We can map your current financial structure, identify structural gaps, and design a shock-resistant framework tailored to you. The booking link is in the description below. Only move forward if you feel ready. Structure building is a long-term decision. If this helped you, Please like, follow, and share. One share might help a family avoid a structural crisis. That matters more than you think. I will see you in the next video. Bye!